Hi, my name's Jessica Chisholm from Huddleston Tax CPAs, and this is Tax Savings for Technology Firms. Today I'm going to talk about entity selection for your business, how to take the auto deduction to maximize your deduction, the meals and entertainment deduction, home office, and when that's deductible, deferring payroll taxes on owners to save tax, and then depreciation, specifically about bonus depreciation and Section 179. So the first thing you should do when you start your business is think about what type of entity your business should be. When it comes to choosing the best entity for your business, there are several different choices. You could be a sole proprietorship, an LLC, partnership, C corporation, or an S corporation. Sole proprietorships are the easiest to set up, but you do pay self-employment tax on 15.3% of the profits. So a sole proprietorship is just reported on your Schedule C of your 1040, so there's no need to file a separate tax return. But you are going to potentially pay the most in that self-employment tax. All you need to do to set up a sole proprietorship is get a business license from your state and you're good to go. LLCs are disregarded entities when it comes to taxes, but you can choose how the LLC is taxed. So if you don't make any elections, then a single member LLC is taxed as a sole proprietorship, or you can make an election to be taxed as an S corporation. Multi-member LLCs default to be taxed as partnerships, but also can elect to be taxed as S corporations. When single-member LLCs are sole proprietorships or multi-member LLCs are partnerships, then like the sole proprietorship, the net profits are subject to the 15.3% of self-employment tax on the profits. When you elect to be taxed as an S corporation, you can avoid some of that self-employment tax. Partnership, you can form a partnership. That's when two or more owners are sharing in the profits and losses of the business. This is a flow-through entity, meaning there's no tax at the partnership level. All the owners or all the partners will receive K-1s, reporting the net income of the partnership, and that will flow through onto their 1040 where they will be taxed. And like the previous examples, partnerships net income is subject to the 15.3% of self-employment tax. Then there's C corporations. With C corporations, you pay tax at the corporate level, and then you also pay tax on any dividends that are taken. So when people talk about double taxation of corporations, they're talking about C corporations. So the only way to get money out of a C corporation as an owner is either to pay a wage or to take a dividend. And that wage is then taxable to you on your personal level, the dividends also. Then there's the S corporation. The S corporation avoids that double taxation and potentially saves on self-employment tax. S corporations are flow-through entities, just like partnerships, so you get a K-1 to report on your 1040. S corporation owners are required to pay themselves a reasonable wage, so a W-2 salary. But the difference between that W-2 salary and what's left in as net income is not subject to self-employment tax and can be taken as distributions. Still subject to ordinary income tax, just like all the other net income, but you can save that 15.3% of self-employment tax on the difference. If you want some more details about how S corporations can save you money on tax, at smallbusinesswebcast.com, we do have a webcast by John Huddleston called LLCs and S corporations explained using them to reduce taxes, so you can check that out. Next, I'm going to talk about the auto deduction. There are two different methods to deduct the auto deduction. Both require you to track your mileage, so it's very important that when you're going out to see clients, running errands for the business, any business-related mileage is tracked, as well as your total mileage for the year. Commuting miles, so from your home to your principal place of business, your office, is not deductible, so you wouldn't track the commuting mileage. Unless your home office is your principal place of business. In that case, every time you leave your home office, it would be, for business, it would be considered deductible mileage. So first there's the standard mileage deduction. That's where you just take the miles that you tracked for business, multiply them by the current year's mileage rate, which for 2018 is 54.5 cents per mile. Some more examples of business miles, beyond going to see clients, visits to job sites, visits to the post office, bank, office supply stores, etc. And like I was saying, trips from your home to your office don't count. With the actual expense method, in addition to deducting or tracking the mileage, you would also track all the expenses to operate your vehicle. So gas, repairs, oil change, loan interest, new tires, licensing, everything that it takes to maintain your car would be tracked. Then you would take the business miles compared to the total miles to find the business use, and you would take, say it's 75%, you would take 75% of the actual expenses and deduct that. You can also take depreciation on the car. But once you elect to do the standard mileage, or once you elect to do the actual expense method, you can't switch back to standard mileage. So you got to make sure that actual expense method over the long term is going to be most beneficial to you. If you change cars every 3 or 4 years, the actual expense method might be the best because you're getting the most out of that depreciation and then turning it over and getting a new car. Next, I want to talk about meals and entertainment. So meals and entertainment deduction did change with the new 2018 tax legislation. Certain meals are still deductible at 50% on your return. Starting in 2018, meals that are for the convenience of your employer are no longer 100% deductible. So, bringing food in for a staff meeting and things like that prior to 2018 is deductible at 100%, but is now deductible at 50%. Meals for travel remain at 50% deductible. Also starting in 2018, business entertainment is no longer deductible. So if you are used to taking clients to baseball games, football games, things like that as part of a business meeting, that's no longer deductible at all. If you are going to claim the meals deduction, it must be for a legitimate business discussion. So you must be able to answer, who was entertained, where did it take place, when, why did it take place, and how much did it cost? So the best thing is to take the receipt at the end of the night, flip it over, write who you were with, what you talked about, and then you already have when it took place and how much it costs right on there. So now we'll talk about the home office deduction. If you are, working for your business as a contractor for a larger firm, or you have a small technology firm of your own, and you are running it out of your home, then you are potentially able to take a home office deduction. So in order to take the home office deduction, you must meet one of the following requirements. So not all of them, but just one of them. It must be your principal place of business, a place where you meet clients, an office that is a separate structure not attached to your house, or a place where you store inventory. Not many technology firms are going to have inventory, but if you are building systems for people, there might be some inventory that you would need to store. How you calculate the deduction is most often using the square footage method. So for example, if you have a 2,500 square foot home and your home office is 500 square feet, then your home office allocation is 20%. So you'll be able to deduct 20% of the cost to maintain your home. So mortgage interest, property taxes, insurance, rent, utilities, etc. If you have a security system, a landscaper, all that would count towards potential deduction. If you use your garage to store inventory or a 100% work use vehicle, then you may be able to deduct that space as well. If you don't track all of that information, then you can also elect to use the simplified method, which allows you to deduct $5 for every square foot of your home. However, this is capped at $1,500 a year. So you need to compare and figure out which one's going to be the best deduction for you. Another thing to talk about with the home office deduction is that the home office must be 100% business use. So there can't be a guest bed in there where your in-laws come to stay on holidays. It can't be also your kids' playroom. It needs to be 100% for business use. One way to potentially either save tax in the current year or a future year is to think about deferring payroll taxes on owners. So corporate owners who are also employees, so this would apply to C Corps or S Corps, you could potentially defer some payroll tax obligations on your income until the following year, or accelerated into the current year. What you can do, since owners are not required to pay their entire salary regular over the course of the years, you can pay a large percentage of the owner's salary at the end of the year in the form of kind of a bonus. If you pay it on December 30th, December 31st, right at the end of the year, then the payroll taxes are not going to be due until the first of the next year. And when you're on the cash basis, it won't be deductible till it's paid out. So if you're trying to maximize income for the current year, you could pay the large amount of the owner's salary at the end of the year, and then those payroll taxes are deferred into the following year. You also want to think about, if you are going to do that large bonus, if you want to minimize your salary for the current year, to pay those payroll taxes before the end of the year. Even if they're not due until January, you can pay them in December. So you want to think about which year you're wanting to maximize your income in. When you pay it all at the end of the year, withholding on a salary is treated as evenly paid throughout the year. So you don't need to make quarterly estimated tax payments to make up for the fact that you're not paying a salary evenly throughout the year. And if there's cash flow needs during the year, that a small salary with a bonus at the end of the year can't cover, you can meet that using draws or loans to shareholder, and then you zero that out at the end of the year when you pay that salary. So the last thing I want to talk about is depreciation, specifically bonus depreciation and Section 179. When you purchase large assets, so perhaps a new computer, a new server, even things like printers, any assets that need to be capitalized and depreciated, you're able to elect to either take bonus depreciation or elect to take Section 179 to accelerate that depreciation. In 2018, the tax legislation for bonus depreciation was expanded from a 50% deduction on new assets to a 100% deduction on new and used assets. And this applies to most depreciable assets with a recovery period of 20 years or less. So prior to 2018, you can take 50% deduction on only new assets, not new to you, but just brand new assets in general. But this was changed to be more in line with Section 179. Section 179 is still around in 2018 and going forward. Section 179 allows taxpayers to write off assets in the year of purchase. This is for new or used assets, and for 2018, there is a limitation of $1 million. And for Section 179 under the 2018 tax legislation, qualifying property has been expanded to include certain depreciable tangible property used in connection with lodging and improvements to non-residential real property such as roofs. So that was expanded slightly. You want to use the potential for bonus depreciation in Section 179 election to your advantage when you're tax planning. If you're trying to maximize income in the current year and perhaps defer into, some expenses into future years, then don't take the bonus depreciation or Section 179. If you're trying to minimize income in the current year, then definitely look into the bonus depreciation in Section 179. Neither of them are required. You can take partial bonus or Section 179 on an asset. You don't have to write off the entire thing. But again, not all property qualifies, so you do want to consult a tax professional when you're thinking about using one of these. So, in conclusion, to maximize your tax savings for your business, there are many different things you need to consider. It's important to just consider what type of entity your business chooses to be, how you write off your assets, using bonus depreciation Section 179 or not using them at all. If you're able to utilize a home office, and when to time your write-offs. So if you have any other questions on your business, feel free to contact us, and our contact information is down here on this slide. Thank you for watching, and have a great rest of your day.